The financial world was abruptly shaken today, May 30th, 2025, by an announcement from Beijing. Chinese authorities declared significant new restrictions on American investments into the People's Republic. This move marks a severe escalation in the already fraught economic relationship between the two global superpowers. The declaration, though initially sparse on specific details, sent immediate shockwaves across international markets. For years, capital has flowed, albeit with increasing friction, between these two economic giants. Today's news suggests a fundamental and potentially irreversible shift in that dynamic. The timing of this decision is particularly stark. It comes amidst a backdrop of renewed trade tensions, with accusations from Washington regarding China's adherence to existing trade agreements. Only hours before Beijing's announcement, President Trump had voiced strong criticism, alleging that China had violated tariff agreements. The move is perceived by many analysts as a strategic retaliation, a clear signal that Beijing is prepared to deploy its considerable economic leverage in new and impactful ways. The implications for American corporations, with significant stakes in China, or those planning future ventures, are undeniably profound and deeply concerning. The restrictions threaten to unwind years of economic integration, forcing a rapid reassessment of global supply chains and investment strategies. The reaction on Wall Street to Beijing's pronouncement was swift and brutal. Trading floors, already on edge due to President Trump's earlier comments about trade deal violations, descended into a state of heightened anxiety. The Dow Jones Industrial Average plummeted significantly within the first hour of the news breaking, shedding hundreds of points as investors scrambled to digest the implications. Similarly, the S&P 500 and the tech-heavy Nasdaq Composite experienced sharp declines, reflecting broad-based fears across all sectors of the American economy. Market volatility, as measured by the CBOE Volatility Index, VIX, surged dramatically. Sell orders flooded the exchanges, overwhelming buy-side interest for many stocks, particularly those with significant exposure to the Chinese market. Specific companies, especially in the technology and manufacturing sectors, saw their stock prices hit particularly hard. Firms like Apple, heavily reliant on Chinese manufacturing and its consumer market, experienced substantial drops. Semiconductor companies, already navigating complex geopolitical currents, also found themselves in the eye of the storm. The breadth of the sell-off underscored just how deeply intertwined American corporate interests have become with the Chinese economy. Initial estimates emerging from the market turmoil painted a grim picture, with some analysts suggesting that the immediate fallout from China's investment restrictions could wipe a staggering $1 trillion off global market valuations. This headline number reflects not just the direct losses in stock values of U.S. companies with Chinese exposure, but also the broader repricing of risk across interconnected global markets. The suddenness of the announcement amplified its impact, leaving little time for measured responses. The calculation of such a colossal sum involves several components. Firstly, there is the direct erosion of market capitalization for publicly traded American companies. Secondly, the figure encompasses the potential write-downs of private equity investments and venture capital stakes held by U.S. entities in China. Beyond these direct impacts, the trillion-dollar estimate also factors in the contagion effect. Fear is a powerful market force, and the uncertainty stemming from China's actions has led to a broader de-risking across global portfolios. The interconnectedness of modern finance means that a shock of this magnitude in one major artery quickly reverberates throughout the entire system. The potential chilling effect on future U.S. investment into China, and perhaps even Chinese investment globally, represents lost opportunities and diminished economic dynamism. While Wall Street bore the initial brunt of Beijing's announcement, the repercussions quickly rippled outwards, underscoring the deeply interconnected nature of the modern global economy. European bourses opened sharply lower, with indices in London, Frankfurt, and Paris all registering significant declines. Companies across the continent with substantial trade links to either the United States or China found their shares under pressure. The FTSE 100 DAX and CAC 40 all reflected the growing investor anxiety. Asian markets, which were among the first to react given their time zone, had already set a negative tone. Emerging markets throughout Asia, Latin America, and Africa, many of which depend heavily on commodity exports to China or are integrated into global supply chains dominated by Chinese manufacturing, also felt the chill. The fear was palpable. A trade war turning into an investment war could have devastating consequences for global economic stability. Investment banks to influential asset managers were thrust into overdrive by China's sudden investment clampdown. Analysts at firms like Goldman Sachs. The initial consensus was one of profound concern. Many internal meetings were convened to discuss risk mitigation strategies. Senior executives expressed paradigm shift. The primary worry was the lack of clarity regarding the restrictions. This uncertainty makes it difficult to advise clients or make long-term resolution. Hedge fund managers were re-evaluating their positions. The immediate market panic, while dramatic, may only be the overture to a more prolonged period of economic strain resulting from China's investment restrictions. One of the most significant long-term effects could be the comprehensive reordering of global supply chains. For years, American companies have relied on China as a critical manufacturing hub. If access for investment and reinvestment is curtailed, these companies will be forced to accelerate diversification strategies. This process is costly, time-consuming, and fraught with its own set of logistical and operational challenges. Another major consequence could be a sustained rise in inflationary pressures. Disrupting established supply chains and restricting investment flows can lead to inefficiencies and higher production costs. The restrictions will undoubtedly impact innovation and technological development. The free flow of capital often fosters collaboration and competition that drives technological advancement. The announcement from Beijing has sent shockwaves through Washington, prompting urgent discussions within the White House and Congress. President Trump, who accused China of violating trade agreements, is expected to respond forcefully. His administration's hawkish stance on China views this as a significant provocation. U.S. policymakers must formulate a robust response to signal displeasure without escalating tensions. Possible U.S. measures include further restrictions on Chinese investments or new tariffs. Diplomatic channels will also be crucial to seek clarity and explore de-escalation. China's decision to impose stringent restrictions on U.S. investments heralds a potentially transformative phase in Sino-American economic relations. The era, characterized by deepening integration and mutual, if sometimes grudging interdependence, appears to be rapidly receding. In its place, a new paradigm of strategic competition and economic decoupling is emerging with greater clarity and force. This latest move goes beyond trade disputes over tariffs on goods. It strikes at the heart of capital flows, a fundamental pillar of the economic relationship built over the past 4 decades. The long-term trajectory now points towards a more fragmented and adversarial engagement. The concept of economic decoupling, once a subject of academic debate, is now manifesting as concrete policy. Both nations seem increasingly willing to prioritize national security concerns and strategic autonomy over the purely economic benefits of open exchange. For the United States, this has meant scrutinizing Chinese investments in critical technologies and supply chains. For China, it now involves limiting American capital in its own economy, perhaps to foster indigenous industries or to reduce perceived vulnerabilities. This mutual pullback, driven by geopolitical rivalry, will inevitably reshape global trade patterns, investment strategies, and technological development pathways for years to come. The new reality of restricted investment flows between the United States and China necessitates a fundamental rethink of global business strategies. Corporations can no longer assume a seamlessly integrated global economy. Instead, resilience and adaptability must become the watchwords. One key strategy will be the accelerated diversification of supply chains. Companies heavily reliant on a single country, particularly China, for manufacturing or critical components must now actively seek alternatives. This involves not just identifying new geographic locations, but also investing in the infrastructure, skills, and relationships required to make these alternative hubs viable and efficient. For investors, the changed landscape demands a more nuanced approach to risk assessment. Geopolitical risk, once a secondary consideration for many, has now moved to the forefront. portfolios will need to be rebalanced to account for the potential impact of sudden policy shifts and escalating tensions between major economic powers. Greater emphasis will likely be placed on markets with strong domestic demand and less reliance on contentious international supply lines.